Hello guys and welcome back. Okay, my returning subscribers, thank you guys so much for the support. Thank you guys for tuning in. For those who are new, my name is Faithful Lobby. Yes, I know my name is Faithful, it's a little different. But I post videos every week on topics related to money, mindset, and business. And today, we're talking about an 800-pound gorilla in the room, guys. And I'm not talking about myself, but let me get serious. No, for real, guys. Recession in 2020. Now, I don't know about y'all, but I've always heard recession in 2013, 2014, 15, 16, 17, 18, 19, and now 2020, and it's the same thing. So, guys, honestly, before I knew what I'm about to talk about today, I noticed that most of the time, whenever someone was telling their opinion as to if they feel we're going to have a recession this year, I most of the time went with the person that was more convincing and more believable than actually the factual and actually understanding what was going on and what stats they were saying and how it made sense if what they were saying was actually factual and it could potentially happen. And I realized I didn't really know a lot of what's going on. That was up until around 2017 when I found a video on YouTube. I'm always on YouTube, guys, by Dalio. And the video that I found was how the economic machine works. Dalio is one of the guys I look up to and I ultimately trust in the financial markets as someone who tells the truth and is always honest about his opinions and sharing his knowledge as to how he got to where he's at today based off the knowledge that he accumulated over the years. Ray opened my eyes as to how I could stop being a pawn in this game and really elevate myself to be a rook or a bishop. The knowledge I'm about to share with y'all today is something that is going to help y'all understand and determine for yourself if you think we're going to have a recession anytime, any period, anywhere, because Ray said that you could apply this in your personal finances, you could apply this to the economy. And for those who stay till the end, I will share my tips on what you can do in order to prepare for the recession and what I am currently doing and what my opinion is on all of this. Okay, so Ray dives and starts the video off with explaining the economy, and he says there are three main factors that drive the economy. The first one is productivity, the second one is the short-term debt cycle, and the next one is the long-term debt cycle. But before Ray dives into these, he talks about what the foundation of the economy is: transactions. And Ray defines transaction as a buyer exchanging money or credit with seller for goods, services, or financial assets. Now, Ray goes and explains what a market is, and he pretty much says a market is just all the buyers and all the sellers making transactions for the exact same thing. So, for example, you have the stock market, you have the oil market, you have the gold market, you have all these markets for buyers and sellers making the same transaction for the same thing. Now, Ray dives and talks into productivity, and he says productivity is what drives the economy over the long term of things. Now, a perfect example is Jay here, guys. Remember Jay? Jay got a fresh chop right here, hairline, straightened and clean fade. But Jay makes $100,000 a year, okay? And now Jay wants to spend $110,000 a year in a world without, let's just say, no credit. For Jay to spend $110,000 a year, he needs to increase his income. And for Jay to increase his income, he has to increase his productivity, okay? And Ray says, another man's spending is another man's income. Very important. Okay, now we have Jordan here, right? So now, let's say Jay here increases his income to $110,000 and he increases productivity by working overtime and doing all these other things, and he's making and spending $110,000 a year. Since one man's spending is another man's income, Jordan over here is making $110,000 a year, and Jordan now wants to spend $120,000 a year. So for Jordan to do that, he also needs to increase his income and increase his productivity. And in order for him to do that, let's say he starts working more overtime, also putting in the work, increases income, and now he's spending that. Now think of that and multiply that over the scale of millions and millions of people. Since his spending is another man's income, this drives the linear graph of what drives the economy, and it's a nice straight line for the productivity growth. Now, this gets a little confusing because Ray then talks about credit. And he said credit is the most important part of the economy and the least understood. Now, when Ray talks about credit, he said credit spends just like money. Credit and money are pretty much almost the same thing from a spending perspective. And he says there's actually $50 trillion of credit out in the market right now. And there's only about $3 trillion actually of cash in the market right now. Well, this was in a 2013 recording. I'm sure that's all changed by now. But Ray talks about now, let's give an example here back to Jay, right? Let's say in a world where, in an economy where credit exists, which is our economy, now Jay wants to spend $110,000 a year, but he only makes $100,000 a year. But Jay doesn't have any debts, so Jay can get a credit card that offers him $10,000 on his credit card. Now Jay could spend $110,000 for that year without having to necessarily increase his productivity. Credit enables him to do that. Now, since another man's spending is another man's income, Jordan now makes $110,000, and with him getting approved for a credit card with another $10,000, he's able to spend $120,000 a year. And now this multiply this by millions and millions of people. This creates productivity funded on credit. Now, Ray talks about how credit helps boost the productivity in the short term, but doesn't in the long term, because you're borrowing against your future self when you have credit. He gives a very perfect example of when you go to the bar and you open a tab. When you go to the bar and you open a tab with the bartender, you're promising to pay that bartender in the future, and you're going to pay him the money you owe. Another example is when you go buy a house. You take out a mortgage and you're promising to pay back that mortgage principal plus the interest at the interest rate of what is set for that amount. Ray talks about how when you're going to buy something you can afford, you're essentially borrowing money from your future self in order to buy something you can't afford right now, which creates a cycle, because it will require you to either cut down on your spending and cut down on your liabilities in the future, or drastically increase your productivity and increase your income in order for you to pay back that debt that you borrowed from your future self. This is very important because this is how credit works. And Ray talks about when credit is created, debt is created at the same time. So what that means is the debt is an actual asset to the lender and it's a liability to the borrower, because you're promising to pay that debt back in the future, principal plus interest, and that's an asset to the lender because they usually want to make more of their money, and usually the borrowers want to buy something they can't afford. And this creates a cycle, and this cycle is what leads to the short-term debt cycle. So Ray talks about how credit is not necessarily a bad thing unless it fuels overconsumption. Now, credit is not necessarily a bad thing, because if you borrow money to start a business and you're able to allocate resources and you're able to hire people and generate income from that business to pay down that debt and also pay yourself, this is a good thing because you're benefiting the economy and you're growing and getting income for yourself, increasing your productivity, and at the same time increasing and benefiting the economy. Now, if you go take out money and debt to fund consumer things such as me buying a car, it's a perfect example, guys. And I essentially borrow from my future self in order to pay down that debt later on in the future. Now, this then leads to a cycle because you're borrowing from your future self, which will require you to cut your spending in the future. You're increasing your productivity temporarily, but if you don't put that money to work for you, you're essentially dooming yourself in the future in the lower end because you need to cut your costs. And this is called the short-term debt cycle. Now think about this, with millions of people multiplied living off of just credit fueling with consumer credit debt and everything, right? This causes inflation, and essentially inflation is the amount of demand in the market is greater than the supply. This is basics of economics. And as the demand increases because more availability to credit, more people can spend more money than they make. This drives the price of goods really, really high and causes inflation. And this introduced the Fed. Now, guys, I'm not talking about the police or people kicking, the FBI kicking down your doors or anything. I'm talking about the central bank. Now, guys, if you don't take anything from this video, make sure you take this, because the Feds is the most important aspect when it comes to economics and the monetary policy of things in America. The way the Feds are able to control inflation, which they try to keep around 2% every year, is by controlling interest rates and printing more money. Now, there are two ways the Feds can control interest rates. They can either increase interest rates and lower interest rates. So you're probably asking yourself, how does that affect me, right? So let's say you want to go buy a house. Depending on where the Fed's interest rate is, what the Feds usually do is the banks actually go to the Feds and they give them money or lend money to the banks, and determining based off the Fed's interest rate really determines what the interest rate of the bank is going to give you. The higher the Fed's interest rate, the higher your interest rate that you're going to be getting for your loan from the bank. The lower, the better. When the Fed increases interest rates, this is called quantitative tightening. That means that inflation is running too hot and they feel like they have to reduce the amount of flow of credit in the system in order for them to actually balance out the supply and the demand factor. Now, this is very important because in quantitative tightening, the Feds is actually increasing interest rates, which causes banks not to lend money to you, or when they do lend money, it's at a high interest rate. So let's take Jay here, for example. Jay's making $100,000. He wants to spend $110,000 on this, and he wants to spend the extra $10,000 on this credit card. Now, let's say his credit card interest rate went from 20% to 35%, for example. Jay would be like, maybe I shouldn't spend that much on my credit card. Maybe I shouldn't take out any more debt. It's kind of expensive right now to get money. I don't want to get money. Essentially, this is what's also occurring in the banks with the consumer banks and the central bank. So a perfect example to give you to wrap all this around your head is the '08 crisis. This was mainly geared in the housing market. So what happened is mortgage-backed securities got created, and it's the banks putting the debts of all the mortgages of people who owns mortgage, because they know people are always going to pay their rent, and they bundled it together and created an asset for it and was giving that out to investors to invest in, and that's essentially what mortgage-backed securities are. But what happened is they were yielding such high returns that everybody just wanted mortgage-backed securities. And what happened is banks just started lending to every and anybody that walked in the bank. Janitors were owning $1 million homes. The people were able to buy 6 houses at once, 10 houses at once. And it was just a roaring market. And essentially what happens is this inflated the housing market because the demand for houses skyrocketed and the supply was not as much. The way the Feds was able to stimulate the economy all back together was first implementing ZIRP, which is 0% interest rate. Pretty much they took the interest rates to zero, which stimulated the banks to be able to go and, incentivize them to go borrow more money in order to give it to the consumer at interest rates that would yield them returns. And also they implemented TARP, which was Troubled Assets Repurchasing Program, which they printed $2 trillion, guys, in order to purchase all those government bonds and mortgage-backed securities that was not being purchased on the market in order to get United States out of the depression. Now, the Feds, guys, is very important. They control everything. If you're living in any country, anywhere that has a central banking system, you must understand this model, because I feel like a lot of what's going on right now, if people just understood the basics of how the Feds functioned and what is currently going on in the market, you'll be very upset with what they're doing right now. But that's a whole nother topic for a whole nother video that will not go down that rabbit hole today. And now next is what Ray talks about is the long-term debt cycle. What I forgot to mention earlier is that in the short-term debt cycle, it's typically happens every 5 to 8 years. And this is when you always hear, we're due for a correction, we're due for a recession. It's been 10 years, it's been 8 years. Every or so years we have that market correction, and this is what he calls this the short-term debt cycle. During the long-term debt cycle, this usually occurs every 75 to 100 years. As I learned more of history and the history of economy and the history of just the global economy as a whole, there's always been regimes that have always reigned as the global reserve currency. And currently, the United States is the global reserve currency. Every 100 years or so, a new global reserve currency comes into power. Now, guys, I know it might sound crazy, but guys, it's been almost 100 years, and before we actually were the global reserve currency, it used to be the pound sterling. And in Ray's point, he talks about how when everything is being fueled by debt, and your debt increases faster than your income, this is when this bubble pops. Now, if you look at our current economy right now, we're spending at a deficit, guys. $1 trillion deficit. Essentially what a deficit means, we're spending more than we actually make. So the amount that the feds, the central government actually takes in taxes, is actually less than the amount that the government actually spends on the economy. We're increasing at a tremendous rate as to how much we're spending and increasing our budget deficits. I want us to care about our finances and about our money and understanding some of these basics, and not just be pawns in this game, but actually start taking action and sharing the knowledge. And now that you're armed with this ammo of knowledge, you can decide for yourself what you think is occurring in the market currently and when you think a crash might occur. Now, guys, it's way more complicated than this, but this is one of the best and easiest way I found for the economy being explained. I will link in my description down below the video to this economic machine and how it works, and I advise you guys to watch it. It's only 30 minutes, but I promise you it's 30 minutes of knowledge that will change your life, because it definitely changed my life, and I look at things completely differently now. Now, guys, please make sure you share this with a friend. If you love this content and really learned something new and liked it, hit the like button. I really appreciate it, guys. This takes me a lot to put together and to actually research and understand and get the content out to y'all. And thank you guys so much for the support so far. Please share this with a friend. Share the knowledge, guys. The more we care, the more we're going to get better at this. With that being said, I want to appreciate y'all. Oh, y'all thought I forgot. I didn't forget. Okay, if you made it this far, thank you. You're actually a real one. So let me dive into what my tips are and what I think you should be doing in order to make sure you sidestep yourself against a lot of what you think might be going on, or what part of the cycle you feel like we're in. And first tip is have an emergency fund, guys. I feel like that one is like repeating the same thing, right? And I can't lie to you guys, it took me a long time to really understand why emergency funds were so important, but I promise you guys, have a 3 to 6 month emergency fund saved up just in case anything happens. And you could always, in case anything happens that you don't see coming in life, you can always sustain yourself for the next 3 to 6 months and give yourself that buffer in order to get things and restructure things in your life. Next is, okay, guys, first assess your current situation and look at where you're currently at right now. Now, to give you an example, what I did was I look at my portfolio, I look at my asset allocations and the different markets and industries I'm in, and I look at what happened, right? And I look at what is the worst that could happen, right? Take for example the 2008 crash, and I'm like, okay, what specifically happened? What caused it? How did it occur? I assessed everything that got affected by the 2008 crash, and I just kind of replicated it on my portfolio, looking at it and say, okay, if my portfolio was to go down by this much, how would it feel? How can I restructure to hedge myself to make sure I don't get as affected as much? And this is very important to do, because if you're able to assess the worst thing that could possibly happen in your current situation right now, you're able to create a plan and take action to make sure you can defend yourself and avoid certain things that will happen in the future if this was to occur. Now, This means to me now diversification. Now I'm not going to get too much into the today's video about diversification of the portfolio that you have for yourself, but I'm just going to leave it there. Diversification, diversification, diversification. And that's one of the best ways I like to look at my portfolio. How much can I diversify to inverse the relationships in a lot of these markets and a lot of these sectors? Next is, guys, I promise you when this happens, this is one of the best ways to increase your wealth. So a lot of what people did in the '08 crashes, they were buying on a downturn, they were buying in real estate, they were buying in this cheap times, because think of it like a discount occurring. This is free discount, free money, free people out there just ready to let things go because they can't afford it. And this is time for you to come in, swoop in and buy a lot of these cheap assets and be able to ride the wave back up. And let me know in the comments how you guys like this and what you guys think. I really appreciate y'all. Those are my tips. Those are what I'm currently doing. I'm paying down all my high debts. Also, last but not least, before I forget, how can I forget? Pay down all your high interest debt, guys, or restructure them right now while the interest rate is currently cheap. If you don't have a fixed rate mortgage, restructure that, get a fixed rate 30-year mortgage. If you have high student loan debt, refinance those student loan debts and get those down. Pay down all your credit card debts, pay them all off, because these are things that will help you if this was to happen. And that's what I mean by assess all your risks that could occur based off the current situation and position you're sitting in. And with that being said, guys, thank you guys so much. I really appreciate it. You guys have a killer rest of the week. Again, move with purpose, have purposeful thinking. Thank you guys, and I'm out.